Well, there is always a ton going on in the world. If we only had someone that understood the big picture and real estate, boy, that'd be great. And we do. It's our friend, the Rebel Capitalist George Gammon. Hey, George.
Hey, Robert. Thanks for having me on.
Well, it's been too long.
There's so much
I
going
know.
on.
Too bad nothing's going on, man. Well, I wanted to pick your brain because there's so many things and they're moving in different directions and there's a ton of speculation out there. And most of the people we hear from really aren't real estate investors. Your background in real estate and understanding that and your background in business prior to that makes you the right guy to talk to, because really you're self-taught. You're not a guy that's got, years of a university and figuring out, the way it was taught in books, but you figure all this stuff out. I think big picture is there's a lot going on right now. And as real estate investors, it can be evasive to figure out, well, what does it matter to me? I mean, we understand things like, well, if interest rates change, but what about the whole private credit thing and the impact the war is having and all that stuff? What's on your mind right now?
Well, I think we need to address interest rates first and foremost.
Yeah.
Robert, because that's what most real estate investors get wrong. So what I mean by that is interest rates don't control the economy. They're a reflection of the economy. And so let's unpack that, because it's a very, very important concept to understand. So most people think that, oh my gosh, if the Fed would just drop rates, and we could get mortgage rates down and everything, it would solve all of our problems. But what people need to think about is the fact that they have to drop rates. What does that tell you about the underlying economy? So Milton Friedman first pointed this out in the 1970s, where he said that it's a fallacy. Low interest rates mean loose monetary conditions, when in fact low interest rates usually, often, not always, but often imply very tight monetary conditions, and high interest rates imply very loose monetary conditions. Then it's very counterintuitive. It's the opposite of what most people think. So why is that? So again, let's go back to the Federal Reserve and where we are right now. The Fed funds overnight rate is what? Where are we? 3.6 roughly?
Yep.
So let's just assume that the Fed takes interest rates right back down to zero. Okay, well, why would they do that? Why would they do that? They would do that because the labor market is blowing up. Let's say we start to get consistent negative non-farm payrolls. I know we had a good number the other day, but that could easily be downwardly revised, as most of them have been.
As it usually is.
Yeah. So, you get a couple quarters of negative GDP, you get the labor market, you touched on private credit, which is a really, really, really big issue we need to circle back to.
Yeah.
So if all these things are causing significant, noticeable problems, then the Fed will drop rates. Well, okay. If so, does that mean that monetary conditions are going to be loose? Absolutely not. They're tight because risk is high. And at the end of the day, liquidity in the system is not a function of interest rates. It's more so a function of perceived counterparty risk. Right? And you think about it, if you owned a bank and you had someone that came to you and wanted to borrow $1 million, are you going to give them that loan based on where interest rates are? Or are you going to give that loan based on the probability they pay you back? And so now you can say that there's more demand for loans at lower interest rates. And obviously that's true, but that gets technical. And where that gets technical is it's not accurate to say there's going to be more demand at lower interest rates, because again, that goes back to, well, what is this telling us about the economy? You can only say that demand is higher than it otherwise would have been.
Yeah.
So let's, just so everyone's following us there, let's say that the demand for loans is at a 10 on a scale of 1 to 10 when interest rates are at 5%. Okay. And let's say that when interest rates go down to 0, the demand goes down to 5. Why would it go down to 5 at 0? Because the unemployment rate no one's got a job. The unemployment rate has gone from, let's just say 4% up to 8% or 9% or 10%. I mean, think back to the GFC, right?
Yeah.
In 2010 and 2011. Was there a lot of demand for loans to buy real estate back then? No,
No.
because the unemployment rate shot up and we were on the tail end of that recession and no one wanted to touch housing or real estate with a 10-foot pole.
Right.
So you can say that demand is at a 5, and it is true to say that if interest rates were still at 5%, that demand would be at a 3, and therefore, under those economic conditions, and therefore a 5 is higher than a 3, yes, but 5 is lower than a 10.
Yeah.
So that concept, people really need to get their head around that often low interest rates are an indication of very tight monetary conditions that are a result of increasing counterparty risk within the economy and within the financial system. And therefore, low interest rates aren't really stimulative. Often they're the opposite of that because of what it tells you, again, about the underlying conditions in the economy. So main takeaway there is low interest rates don't control the economy. They are a reflection of what is happening in the economy.
It's a great point, because when you think about the whole way that the economy works, and when there is demand for anything, in this case, we think about it as real estate investors, like, man, if I could just get a house at a lower interest rate, then my cash flow would be better. But that's not the
renters.
Right. That's not the majority of the folks if times are bad. And so as much as we're hoping for low interest rates, understand that in context is huge. And I remember another thing you brought up at the Investor Summit a couple of years ago, and that was that the availability of loans is a completely different topic than the interest rate being charged, which you just talked about, because I want to make a loan to a prudent individual that's independent of the interest rate. Banks and other lending institutions, they really don't care what the interest rate is, right? They're on arbitrage, so whatever it costs them, if they can lend out at a profit. But most real estate investors are still locked in that paradigm. Man, I'm just waiting until rates get back to 4.
Yeah. And let's look at my personal story, which you know well. I retired in 2012. And when I retired, I didn't know the first thing about investing or economics or none of that. Yeah, I almost flunked out of high school. I've never taken an econ class or a finance class. So I had to dive in and get my hands dirty and figure things out. And I decided that was a good time to buy real estate. This was August of 2012. It turned out to be a pretty good timing.
Yep.
And so I accumulated about 20 single family properties, really good neighborhoods in Kansas City. Those of your audience, or anyone in your audience is familiar with Kansas City, the Missouri side. This was in Blue Springs and Lee's Summit, mostly. So I had about 20 rental properties, 3-bed, 2-bath, 4-bed, 2-bath, and I paid for them in cash. So I have zero debt, no debt whatsoever. And I have renters in all of them they're paying me between $1,000 and $1,300 at the time, if my memory serves me well. So I've got renters in all of them, or all of them but one, or something like that. Yep. And so they're cash flowing, just a cash cow. You fast forward to maybe the middle or the end of 2013, and I'm like, okay, I've got massive amounts of equity here. Maybe I want to at least set up a line of credit. Not that I'd even want to draw it down, but just set up a line of credit. So if I think of some creative way to use it in the future, I've got it. So I went to all the banks there. And by the way, I have a 780 credit score.
Yeah.
So I go to all the banks back then and say, hey, could I just get a line of credit, maybe 40% LTV, 40% LTV. And every single one of them just gave me the Heisman. They no, get out of here. The rejection. Like, look, that was, you could not have a better loan scenario for a bank, and they wouldn't touch it. Why? Because perceived counterparty risk. And by the way, interest rates were at 0% back then. But everyone, it seems crazy to say now, but back then the prevailing narrative and opinion was that real estate was just going to continue to go down and down and down and down forever.
Yeah.
and that real estate was a terrible investment. And, we had that recency bias, and the banks have the recency bias just as much as the retail investors did. So you see, that goes back to Milton Friedman, that at the time, interest rates, as we all know, were extremely low, incredibly low.
Yep.
But money was actually very tight, because it's not about interest rates. It's about that perceived counterparty risk, which, I mean, is a perfect segue into private credit.
Yeah, and this is anyone who's paying attention at all has heard the news and the arguments about private credit. Take us through that, George.
Yeah, so I think in order to do that, we got to go back to 2008 again,
Yeah.
because that was another subprime crisis. And back then it was subprime mortgages. But here it's subprime credit. It's still subprime. And I thought, by the way, I thought it was funny that Powell came out the other day and basically said that subprime private credit is contained. Remember when Bernanke said that?
Yeah, exactly.
It's like history is just, you see it. It's like, I've seen this movie before.
It's rhyming right in front of me. Yeah.
I know how it ends. And the misconception that most people have about the GFC is that it was caused by bad mortgages. It was caused by, all these bad mortgages are on the bank's balance sheet.
Yeah.
And no one's paying back their loans because they're all, the strippers or whatever that we saw in the Big Short movie that had 10 homes, the guy working at McDonald's or something like that, these liar loans.
Yep.
But what most people don't realize, and I'm sure you do, is the default rate on mortgages in 2008 went from like 1-2%, and it
Yep.
went up to maybe 5,
Right.
6. And so there's a bit of wiggle room there because it depends on how you define default. But what most people think is the default rate went from like 1% to 50%. No, it's not what happened.
No.
There weren't that many. In fact, a lot of the banks got bailed out. A lot of them, these big funds came in and bought those mortgages at like 20 cents on the dollar and
Yep.
made a fortune. Because they didn't default. That was definitely the straw that broke the camel's back. But what did the subprime mortgage crisis actually do? What it actually did is, within the financial plumbing, it increased counterparty risk, perceived counterparty risk. Now, why is that important? So most people, they get myopically focused on, now with private credit, it's like, oh, well, there's only $1 trillion worth of private credit, and there was whatever, let's say 20 trillion worth of mortgages back in 2008. Therefore, you can't compare the two. This is much, much smaller. That is a huge mistake, because again, that implies that the problem is just the asset on the balance sheet of the bank or the shadow bank or whatever it is, right? Or the problem is just the derivatives market with credit default swaps or something like that. That's not the problem. To understand the problem well, you have to think about how a car engine works. And within that car engine, there's oil. We have to have oil. Everyone knows that. We
Yep.
have to have oil in the engine because that oil is circulating and it's lubricating each one of the components of that engine. Now, what happens if you're running an engine and you take all the oil out?
It seizes
doesn't
up.
it?
Yep.
Seizes up. People have to understand that the financial system is the exact same. It's the exact same. So what is the oil in the financial system? It's the circulation of money and credit.
Yeah.
So the GFC wasn't necessarily, the root cause of the GFC wasn't necessarily the subprime mortgages. It was the circulation of money and credit stopped. And the reason it stopped was, number one, exactly what we're talking about, counterparty risk, perceived counterparty. That's very important. I always say perceived counterparty risk, because even if let's just say right now with private credit, they're sitting there trying to tell us that the assets are worth 100 cents on the dollar or maybe 99 cents on the dollar. That doesn't matter. It doesn't even matter. Because as long as people, it doesn't matter if they're making rational decisions or irrational decisions, the net result is the exact same. You see, it's the exact same. So what happened back in 2008 is you had the counterparty risk going up. Now, if counterparty risk is going up in and of itself, then you can get away with that for a short period of time if you have sufficient collateral for the loans.
Yeah.
Or if you have sufficient, said another way, just keeping it on topic, if you have sufficient collateral for that circulation of money and credit, for the circulation of the oil within the engine to continue. Now, the problem back in 2008 was a good percentage of the credit that we were using to make sure that oil was circulating, not just in the United States, but in the global economy. In the global economy, a good percentage of that collateral were mortgage-backed securities. See where I'm going with this? So if all of a sudden, even if the mortgage-backed securities, there's only a 3% default rate, you don't know what's hiding behind the shadows. Right. So what you're going to do is you're just not going to lend at all. And what you're going to do is you don't know what's going to happen. You're scared. You're freaked out. You see CNBC. You see the whole thing melting down. So when you have that counterparty in the Eurodollar system that comes to you that wants to use a mortgage-backed security as collateral, you're like, no, just no. I don't care how good it is. I don't care if it's a mortgage-backed security. I'm not accepting it.
Yeah.
So therefore, what you do is you take the amount of, imagine a pie chart. You take the amount of collateral that we had in the system that facilitated the oil moving throughout the engine. You had, let's just say 50% of that collateral almost overnight was eliminated. It still existed, but no one would take it. So the only thing you were left with were treasuries for collateral. So once you understand the real cause of the GFC, now we fast forward to today. And all you have to do is ask yourself, what is happening with private credit? Number one, what inning are we in?
Yeah.
And how do these cycles typically play out in the past? Because most of the cycles, a large component of what drives the cycle is actually psychology. So we know that human psychology has not changed since 2008. We know that for sure.
Yeah.
And so it's eerily similar what we're seeing with first it's, Tricolor, it's First Brands, they start to blow up. They're kind of the recipients of some of this shadow lending. And then you start to see Blue Owl. Well, they're kind of gating redemptions. And, this was maybe 6 months ago or whatever. But then it always escalates. It always escalates. Think about this whole private credit issue that we've been dealing with for the last, 6-9 months. At any point in time, have you seen a de-escalation? The answer is no. It says every single week it gets worse and worse and worse and worse. The exact same thing that happened during the GFC. Why? Because cycles are going to cycle. Cycles are going to cycle. Humans are going to be humans. We're going to go through booms. We're going to go through busts. And although they're never, ever, ever the exact same, they almost always rhyme, especially when you're talking about a credit bust. And when you look at the way these private credit loans were issued, it's the exact same as the mortgages. It's the exact same. You had a flood of money coming in. You had people searching for yield. And so you had all of these fund managers that come in that are giving out these loans. They have all this money, so they can't sit on cash. So they have to do something with the money that's coming into their fund, right? So they have to literally find people to give money to. Oh, you only want 100 million? Let's make it 200. Because there's so much money funneling into private credit, not now, but over the past 5 years.
Yeah.
And there's not enough loans to give. There's not enough software companies. Let me take that back. There's not enough good. There's not enough good loans to make, right?
Yeah.
But these guys don't care. Why? Because think about it from their standpoint. If their fund blows up, how does that impact them personally? Zero.
Not much.
It doesn't. So this is like what I call a free call option. From the standpoint is for them, it's all upside. Because if they give out all these crappy loans, just like the mortgage brokers back in 2008, if they give out all these crappy loans, then who cares? I'm just collecting fees. I'm getting rich. Now, if those loans blow up, what do I care?
It's not my
going to
money.
impact my balance sheet.
Right.
So it's the private credit. It's the exact same incentive structure where these guys that run the shadow banks, It's called Apollo, or the guy running these funds at not just Blue Owl, but now it's Blackstone, now it's BlackRock, now J.P. Morgan has significant exposure, Morgan Stanley has significant exposure, Deutsche Bank. I mean, this is again, this is not contained here, right? So these guys, they take all the money, and then if they lend that out to all these crappy, what I just call it, toxic sludge companies. Another good way to look at it, Robert, is people with a credit score, because everyone can get their head around a credit score.
Yeah.
So at the beginning, when money is funneling into private credit, there's all these guys out there, real estate investors, let's say, with 700 credit scores. Fantastic. But what happens is the more and more and more and more money that comes in, especially when retail comes in, now there's no more 700 credit score guys to lend to.
Yeah.
So you got to go down to the 600 credit score guys, and they're incentivized to do it because they got to get their fees. They got to get their fees, and it doesn't matter if those loans blow up, because that's the investor money. It ain't my money. Yeah. And so then you get down to the 550. Then you get down to the 500. You see, and that's where we are. In fact, we probably got down to the 450, if that's even a thing, a credit score. So then once the 400 and 500 credit score loans start blowing up, then they have to gate redemptions. And that makes people want even more redemptions. And then you've got this black box business model, which is going to do what to perceived counterparty risk? Going to make it skyrocket, especially because it's a black box. At least with the mortgage-backed securities, I would argue they weren't as opaque, not even close to as opaque as these private credit loans are. Where, let's remember, what shows you the valuation of the specific loan they have on their balance sheet. I'm talking about these, the Apollos and the Blue Owls and whatnot, is just them telling you that it's what it's worth.
Yeah.
Well, how much is this worth? When they're talking to their investors, well, how much is this worth? Oh, goodness gracious, it's worth 100 cents on the dollar, easy. Really, based on what? Based on our analysis. Oh, really? Yeah. Oh, really? And then what they started to do, Robert, is the funds started to invest in other funds. So if you have a loan to, let's say, Apollo lends money to BlackRock, and then that's a liability for BlackRock, that's an asset on Apollo's balance sheet. But they're both buddies, obviously. They're in the same ruse, scam, I would call it. And so what Apollo can do is they can tell their investors that that loan is valued at whatever BlackRock says it is.
Yeah.
And then BlackRock can go ahead and lend money to Apollo and do the exact same thing. and nobody knows, because you just got to take their word on it, because there's no price discovery.
Yeah.
There's no price discovery at all. So now we're at the stage where they're going to have to start selling because of the redemptions. And, they've got them gated in at 5%, but I don't know how long that's going to illegally, sure, from a PR standpoint, probably won't last much longer, where they're going to have to sell some of these loans. Then you get the price discovery, then the whole entire thing implodes.
Yeah.
It completely implodes, because then all these loans that they were saying are worth 100 cents on the dollar, when they actually have to sell them, they discover that they're worth 10 cents on the dollar. And then you have just absolute panic. I mean, I'd like to remind everyone that BlackRock came out just the other day and was talking about one of their funds and some of these loans that they had made, these private credit loans and some of their funds. And they have to report quarterly as far as what the value of these loans are. Last quarter, so 3 months ago, Robert, they reported that they are worth 100 cents on the dollar. 3 months ago.
Yep.
Just last week, they report that that's actually worth 0 cents. Zero. It didn't go from 100 down to 90. It didn't go from 100 down to 50. In 3 months, 100 down to zero. Zero. So you tell me how good their underwriting is. You tell me how good they are. Or let's be, how honest they are. That's what it boils down to. Just it's fraud. It's complete fraud. And the reason they're being fraudulent is because the longer they can keep their investors in the fund, the more fees they get. The more fees they get. And if the investors take their money out now, well, sure, they might get 70 cents on the dollar. But if we keep them in for another year, then they'll get 10 cents on the dollar. But who cares, because I'm still getting fees for an extra year.
Yeah.
That's the game that's being played here. But from a macro standpoint, why it's important
Yeah.
is because it creates the environment, or even if this is psychological, it doesn't matter. It creates the environment where you have an increase in perceived counterparty risk, which decreases the circulation of oil in the engine. And we're right in the middle of the circulation of that oil getting slower and slower and slower and slower until it likely stops, ceases. And does that cause a GFC? I don't know. But it most likely, and again, there are no certainties, only probabilities, but it most likely ends in some sort of credit, severe credit crunch. And that most likely ends with interest rates being extremely low, but the unemployment rate being extremely high for your renters. And by the way, could anyone have predicted this? Yes and no. So you could not have predicted the exact way that things play out. That
Yeah.
Nobody knows that because nobody has a crystal ball. But you can predict the cycle and where we are in the cycle and how the cycle will likely play out. So you've been hearing me, talk and preach for 2 years now, 2.5 years, maybe longer, on how the yield curve inverted.
Yep.
Twos and tens. Remember, in fact, I think, in our mastermind group, people got sick and tired of me talking about the yield curve, the yield curve, the yield curve.
Yeah.
And the reason I was doing that is because a lot of people in our mastermind group are real estate investors. So I was trying to warn them that, you don't want to lose sleep at night, but when you got this yield curve inversion, and especially when that yield curve starts to uninvert, it's not like you hit the panic button, but you don't want to be really aggressive during that time. You want to be more conservative. And because this is telling you where we are in the cycle. Now, it doesn't tell you the timing, but it just tells you where we are. And when you see that curve invert, when you see the curve, especially when it uninverts, that's when you need to be risk off. That's when you need to be structuring your deals in a way that's more conservative. Not that you're not doing deals, but you're just doing it in a way that's more conservative. Our good friend Kenny McElroy is a perfect example of this.
Yep.
So Kenny, like Kiyosaki, a great student. So when I'm sitting there talking about the yield curve, as you remember well, Kenny's paying attention. Kenny's taking notes, right?
Yeah.
And as a result, what he did is he kept things super lean. He kept a ton of cash. What he's done in the last year or so, he's been able to pick off deals at pennies on the dollar because he allowed everyone else to go out there and ignore the yield curve and get over their skis and take on way too much risk, way too much debt, look at pro forma numbers that were totally unrealistic. And then, they go out there and build all these new multifamily complexes at, let's just say 350 a square foot.
Yep.
And now Kenny comes in and he's like, I'll give you 200 a square foot. And he's getting them right and left because they're in so much trouble. They got a fire sale. You just got Kenny sitting there. Now, is Kenny out there buying aggressively? He is, but he's not buying at 100 cents on the dollar.
Right.
He's only buying if he gets it on the super cheap understanding, and he's modeling the unemployment rate going up to 10%. And so he says, if the unemployment rate goes up to 10%, what's my occupancy? Okay, say my occupancy, whatever. Well, let's say it goes down to 70. Okay, if my occupancy goes down to 70, does this asset, based on the price that I'm willing to pay, does it still cash flow? Answer, yes. And there's so many distressed sellers out there in the multifamily space right now. Why? Because money's getting tight. money. Now, has the Fed dropped interest rates since September of 2024? Yeah, they've dropped them. Have interest rates come down? Yes, absolutely. Interest rates have come down. Does it matter? No, because the circulation of money and credit, even in the multifamily space, with the regional banks and the office, has been decreasing substantially. So all these people that take on too much risk, they've got to roll over that debt. They can't roll over the debt at the same LTV, and they're done. They have to fire sell it, and you got Kenny sitting there, willing to buy it at 20 cents on the dollar. So I just wanted to give that example as to why it's so important for real estate investors to pay attention to macroeconomics and to pay attention to the stuff that I'm referring to and pay attention to things like the yield curve. Because you can sit there and say that real estate is local, 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 local. It is. But when we have these big paradigm shifts or these movements from when we go to the boom part of the cycle to the bust part of the cycle, usually it's going to impact you in some way. It's just, it's not whether it'll impact you, it's to what degree it will impact you as a real estate investor. And if you're paying attention, it's a massive opportunity because you can sit there and when it's the right time, build cash. And then when it's the right time, you can go ahead and deploy that cash at the right price, at the right price. You see, if Kenny didn't understand the macroeconomics, he would probably be overpaying for properties right now. He'd probably be willing to pay more than he is otherwise willing to pay. So it's vitally important.
Yeah, good stuff. Hey, George, you always talk about the cycles, and we have to understand where we are, and this has been a great example of that. But now let's talk for a minute about oil, because it's not necessarily a cycle. It's because of the geopolitical actions and all the things going on.
But it's part of the cycle, Robert. It's part of the cycle. So why is it part of the cycle? And this is another, I'm glad you brought this up, because this is another mistake that people make that's because it's very, very counterintuitive. People think that high oil prices equal inflation, higher consumer prices. And over the short run, they do. But, and obviously that depends on how high the price of oil actually goes.
Yep.
But over the midterm, it's actually disinflationary and deflationary. And it's very, very important to understand why.
Yeah.
So when we go back to 2008, let's remember that oil got up to over $140 a barrel.
Right.
And the CPI went from 3.5% in September of 2007 when they started dropping rates to 5.6% in July of 2008. Now, would anybody say that the GFC was an inflationary as far as consumer prices or as far as asset prices? No, absolutely not.
Not at all.
Assets went down by 50%. So we look at that, and the reason you had that increase in the CPI, and everyone thought, by the way, that was going to be inflationary in 2008, was because that oil was going higher and higher and higher, the exact same thing that we have today. But what those higher oil prices actually did, Robert, is they were the straw that broke the camel's back. Because if you remember back in 2008, the labor market was deteriorating rapidly. We had negative non-farm payrolls, very similar to what we have today.
Yep.
So when you increase the price of energy, it is true. That is an input to almost every single thing that we consume. But you have to remember that you're robbing Peter to pay Paul. Because if you're spending more money on gas, if you're spending on more money to heat your house, then you have less money to spend at Target.
Yeah.
Or you have less money to spend at Costco. So what they have to do is they cannot raise their prices, even if their input costs are higher. So then what they have to do is they have to start laying off workers. Because if you are Target, let's say, and your input costs have gone up by 5%, but if you increase your prices at all, the demand for your goods drops off tremendously to the point where you're making less money on net. And that's happening because those people are robbing Peter to pay Paul, because their incomes, their paychecks aren't going up at the same rate as the energy prices. So what does that do? Target has only one option, and that's to fire employees.
Yep.
So then that increases the unemployment rate. Well, less people working, what does that do to aggregate demand? That decreases aggregate demand at the exact same time when the labor market was incredibly fragile to begin with, as we saw by the negative non-farm payrolls. So you see, when oil prices spike and the economy is very strong, then you get some inflation, and it might lead to longer periods of consumer price inflation, but it doesn't necessarily cause a crisis. Where if your starting point is an incredibly fragile economy, an incredibly fragile labor market, and then you add on $150 oil, that oil becomes a tax on the economy that pushes it over the edge. Now, it's just like Rick Rule says, our good friend Rick Rule, it's not really an if question, it's a when question.
Yep.
So even if you take out the $100 oil or 150 oil, the cycle is still playing out the same way. The only thing that the $150 oil does is just accelerate the cycle and exacerbate the cycle. So that's why I want people to look at oil and look at it through the lens of what it does as far as the oil price, what it does to aggregate demand. You see, and that's how you can tell what the 6 month to, let's just say, a year ramifications will be because of that oil spike versus what the short-term ramifications will be due to an oil spike, which, sure, it could lead to some consumer prices. It's almost like a boxer, right, that's trying to trick you into doing something to where they can hit you with the right hook. So they're tempting you by showing you this hand out here. So all your focus is on this. It's like a distraction, right? So they're distracting you by showing you the left hand over and over and over, just so you focus on it, and bam, they hit you with the right hand. And that's the exact same thing that oil prices do. Is they sit there and they get all your focus on the short term and prices going higher, and then they hit that aggregate demand, and then bam, you get the deflationary punch, the right hook from Tyson. So that's usually how the cycles play out.
Well, there is so much to get your mind around, so I'm thrilled that you've been able to join us today. As real estate investors, sometimes we put our heads in the sand and like, well, that doesn't really affect me, but it does. One of my favorite things to do every year is to attend your big event, Rebel Capitalist Live. It's coming up in just a few weeks, and boy, talk about stretching your brain. Tell us what's on the docket for this year's Rebel Capitalist Live, George.
Well, I'm super excited. Number one, you're going to be emceeing it. So that in and of itself means it's going to be a fantastic event.
Let's hope so.
But we got our good friend Kenny McElroy. He's going to be there giving us all of his tremendous insights on the real estate market. Our good friend Jason Hartman's going to be giving us insights in residential. We're going to have Kiyosaki there. That's always a treat, right? To listen to Robert. We've got new people there like Darius Dale, who's an incredible, brilliant guy. Of course, we're going to have Jeff Snyder there. We're going to have Brent Johnson there. We're going to have Rick Rule there talking about commodities, the resource space, if you will. I mean, it's just the speaker lineup is incredible, absolutely incredible. And what's neat about Rebel Capitalist Pro is it's not just one of these kind of corporate conferences where you just go down there and sit in your seat and hear the speakers and just take your notes and that's it. What makes Rebel Capitalist Live special, in addition to the speakers, in addition to the incredible Rebel capitalists that you get to meet and hang out with, is the fact that the speakers are right there. You're engaging with the speakers on a personal level, because we have these cocktail parties that are for everyone, where everyone gathers there. Everyone, from the VIPs to Robert Kiyosaki down to the person that bought the last ticket. And so you're there, you're having beers with Kenny McElroy, or with Jeff Snyder, or with Rick Rule, or Darius Dale. And everyone is just mingling, asking, discussing these vitally important topics, but also networking with their fellow Rebel capitalists, networking with the speakers. And it's not only a vastly educational experience, but it's a very social experience as well. And I think that makes it unique.
Well, there's a couple things that are great about that. First of all, sometimes you get in this headspace and you kind of think, I'm the only one of my friends who's really thinking about this stuff. Then you show up at Rebel Capitalist Live and you got hundreds of new friends. I mean, they're all thinking about this stuff. And then you do another really cool thing. You give every speaker a chance to do a presentation. And just coming for Jeff Snyder's PowerPoint enough, right? He's astonishing. But then you do these panels where you'll then moderate between speakers and get their take. One of my favorite things is to listen to the speakers talk to one another, because you see it in the moment, they get different perspectives, different input, and sometimes they get their thinking challenged. Not everybody thinks the same way at Rebel Capitalist Live, which is one of the gifts, because it forces you to be clear on why you believe what you believe. So can't wait for it. It happens at the end of May. When we come back, we'll get you all the details. You can get signed up. George, this has been wonderful. I know how busy you are these days. Thank you for your time, and thanks for illuminating us about what's happening in macroeconomics.
Thanks for having me on.
Well, there you have it, the Rebel Capitalist George Gammon. If you're interested in staying up to date with George, you can check out his podcast. Rebel Capitalist is what you want to look for, or just go to georgegammon.com. Thanks for watching today. We'll see you next time right here on YouTube.